In 1980, a single ounce of silver could buy you a decent used car. Fast forward to today, and that same ounce barely covers a tank of gas. But here's what Wall Street doesn't want you to know. We are standing at the edge of the biggest wealth transfer in precious metals history, and silver is about to shock the world. While everyone's eyes are glued to gold breaking records, silver is quietly positioning itself for a move so explosive that it could potentially triple your investment before gold even doubles. This isn't speculation. This is mathematics, industrial demand, and market forces colliding in a perfect storm that happens once in a generation. Let me tell you about Sarah, a retired schoolteacher from Ohio who watched gold climb to all-time highs while she sat on the sidelines thinking she missed the boat. Then her nephew, an industrial engineer, told her something that changed everything. He said his factory was burning through silver faster than they could source it, and every electric vehicle, every solar panel, every 5G tower required more silver than the one before. Sarah didn't buy gold. She bought silver. And what happened next will make you rethink everything you thought you knew about precious metals investing. I hope you're doing well. If you like my video, please subscribe to my channel and hit the bell icon for more video notifications. Because what I'm about to reveal could be the difference between watching this opportunity pass by and actually profiting from it. The gold to silver ratio tells us a story that most investors completely miss. Throughout history, this ratio has averaged around 50 to 1, meaning 50 ounces of silver equal 1 ounce of gold. Right now, we're hovering around 80 to 1 in some markets. Think about what that means. Silver is historically undervalued compared to gold by a massive margin. When this ratio corrects, and it always does, silver doesn't just catch up, it overshoots. In 2011, when silver had its last major run, it moved from $30 to nearly $50 in just a few months, while gold moved comparatively slower. The percentage gains in silver absolutely crushed gold, and we're setting up for a repeat performance that could be even more dramatic. But the ratio is just the beginning. Let's talk about something that makes silver fundamentally different from every other investment on the planet: industrial demand. Gold is beautiful, gold is valuable, but gold mostly sits in vaults and on jewelry. Silver works for a living. Every smartphone in your pocket contains silver. Every laptop, every tablet, every electric vehicle charging station. The average electric car uses up to 1 kilogram of silver. 1 kilogram. Tesla alone plans to produce millions of vehicles in the coming years. Solar panels are even more dramatic. Each solar panel installation requires significant amounts of silver for conductivity. And as the world races toward renewable energy, demand is skyrocketing. China, the United States, and Europe have all committed trillions of dollars to green energy infrastructure. Guess what metal is absolutely essential to making that happen? Silver. This isn't optional demand. This is industrial necessity. Now here's where it gets really interesting. Gold mines produce gold. Silver mines, about 70% of the time, produce silver as a byproduct of mining other metals like copper, lead, and zinc. What does this mean? It means silver supply isn't responsive to price the way gold is. When gold prices rise, mining companies can ramp up gold-specific operations. When silver prices rise, you can't just open more silver mines because most silver isn't the primary target. Supply is relatively fixed while demand is exploding. This creates a supply squeeze that could send prices vertical when the industrial sector starts competing with investors for available silver. The investment demand side is waking up too. For years, silver was the forgotten metal. Investors piled into gold, cryptocurrencies, stocks, real estate, everything except silver. But that's changing rapidly. Silver ETFs are seeing massive inflows. Retail investors are stacking physical silver like never before. The Reddit movement that shook Wall Street briefly turned its attention to silver and nearly broke the physical market in a single weekend. Imagine what happens when that energy sustains for months instead of days. The physical silver market is tiny compared to gold. Total above-ground investment-grade silver is estimated at around 2 to 3 billion ounces. Sounds like a lot until you realize that represents roughly $150 billion at current prices. For context, that's less than the market cap of many single tech companies. A relatively small amount of money flowing into silver creates enormous price pressure. Central banks provide another catalyst that favors silver. When central banks print money, when inflation concerns rise, precious metals benefit. But gold gets most of the attention as the traditional inflation hedge. Smart money knows that silver is actually more volatile and more leveraged to monetary debasement. Silver is poor man's gold, but it's also the smart investor's leverage play on monetary chaos. Every dollar that leaves the system chasing hard assets pushes silver higher, faster than gold because of its smaller market size and higher industrial demand. It's a double leveraged play on both monetary fear and industrial growth. Let's address the elephant in the room: volatility. Yes, silver is more volatile than gold. That volatility scares some people, but it's exactly why silver outperforms in bull markets. In the 2000 to 2011 precious metals bull run, gold went from around $250 to $1,900, roughly a 7 times gain. Incredible. But silver went from $4 to $48, a 12 times gain. Same market, same drivers, vastly different returns. The volatility that makes silver scary in bear markets makes it extraordinarily profitable in bull markets. Right now, all signs point to the early stages of a major precious metals bull market. Inflation concerns aren't going away. Debt levels globally are at historic highs. Currency debasement is accelerating. Industrial demand is soaring, and silver is still trading at prices that seem almost laughable given the fundamentals. Technical analysis supports the fundamental case. Silver has been consolidating for years, building a massive base. Every major breakout in silver's history has been preceded by this kind of long consolidation period. The longer the base, the bigger the breakout. We're potentially looking at a launch pad that's been building since 2011. When silver breaks through key resistance levels, the move could be explosive because there's massive short interest in silver futures that would need to cover, and there's years of skeptical investors who will flip to believers once momentum builds. FOMO in silver is unlike anything else because the market is small enough that retail investors can actually move it. Mining costs provide a floor under silver prices. The all-in sustaining cost for many silver miners is in the $20 to $25 range. At current prices near $30, margins are decent but not extraordinary. As prices rise, mining stocks become incredibly leveraged plays. A $10 move in silver prices can double or triple a mining company's profits. This creates a feedback loop where rising silver prices boost mining stocks, which attracts more attention to the sector, which brings more investors to physical silver. The entire ecosystem feeds on itself in a virtuous cycle that can run for years once it starts. Geopolitical factors add another layer. Silver is strategically important for defense applications, electronics, and green technology. Countries are realizing that control of silver supply is a strategic advantage. China has been stockpiling silver for years. Russia and India are accumulating. Smart governments understand that silver is more than just money. It's industrial power. As tensions rise globally, as supply chains become weaponized, as countries prioritize domestic production of critical technologies, silver becomes increasingly important. This isn't reflected in today's price, but it will be. The coming years will see a generational shift in energy infrastructure. Every country on Earth is under pressure to decarbonize. Solar, wind, electric vehicles, grid storage, all of it requires massive amounts of silver. The Silver Institute estimates that industrial demand could increase by 40% or more in the next decade. Meanwhile, available supply grows at maybe 2 or 3% annually. The math is simple and undeniable. Something has to give. Either prices must rise to destroy demand, which won't happen because this demand is mandated by policy, or prices must rise to incentivize recycling and hoarding behavior, which creates its own supply problems. Either way, prices go higher. Sarah, the school teacher I mentioned earlier, didn't get rich overnight, but within 18 months of buying silver, she watched her investment grow by 60% while gold moved 25%. She didn't have some secret information. She just understood the fundamentals and had the patience to let them play out. The opportunity in silver isn't about timing the perfect entry point. It's about recognizing a massive structural shift in supply and demand that's already underway. It's about understanding that silver is uniquely positioned at the intersection of monetary chaos, industrial revolution, and market psychology. The smart money isn't choosing between gold and silver. They're holding both, but they're overweight silver because they understand the leverage, they understand the supply dynamics, and they understand that the next decade belongs to the metals that power the future. Not just the metals that store the past. Silver is both. It's money, it's industrial metal, it's a strategic resource. Gold is magnificent, proven, reliable. But silver could outperform gold dramatically in the coming years, and the investors positioning themselves now could look back at this moment as the opportunity of their lifetime. The question isn't whether silver will have its day. The question is whether you'll be holding it when it does.